Welcome to the Nichols Tax Update Podcast. It's a busy week. We have 10 items. Let's get through the disclaimer. I want to make sure that I acknowledge the value of my subscription to Tax Notes Today, published by tax analysts. In my opinion, the best source of current information about the federal tax law available to practitioners today. What's in this week's edition? 10 items. It's a busy week. Updated frequently asked questions on the recovered rebate credit claimed on your 2020 return. Some of us are still trying to get that straightened out. Why organizations cannot have tax-exempt status. A reminder that we should not forget the special charitable deduction rule for 2021. $300 for individual taxpayers, $600 on a joint return. When are you actively engaged in a trade or business? We've got a taxpayer who unfortunately learned the hard way that he was not. And then I have a whoops. The IRS withdraws compensation reporting rule that's over 20 years old for exempt organizations on the compensation paid to their executives and other highly compensated individuals. We are now required to do something different. Don't make the mistake of holding on to the old way, because that's going to be wrong. Then bankruptcy court requires a tax attribute to be returned to the estate. That had the effect of the taxpayer having to give up the deduction, return the refund, and then the bankruptcy estate maybe could use the attribute or not, as we'll see. More practice units, 4 of them, on fairly obscure topics you might think, but I think there's a little guidance, something in there that we all ought to pay attention to. And then poor record keeping costs these taxpayers $4.4 million in a bankruptcy and insolvency imbroglio. Is remote workforce the new normal? And what's the law for South Carolina workers that go work in North Carolina or work in Georgia, or workers from those states who come to work, for that matter, in South Carolina? And then finally, IRS updates guidance on 2 subjects: accounting method changes to reflect changes in the final regulations that implement the Tax Cuts and Jobs Act, the small business changes, and the adequacy of disclosure to avoid accuracy-related penalties under Section 6662 and 6694. That's going to be that's a busy agenda. Let's get started. Final updated frequently asked questions on the recovery rebate credit. 7 topics, 36 pages. You should have a copy at hand in case you need to answer these questions. Topic A, claiming the credit if you're not required to file a 2020 return. Topic B, eligibility. Topic C, claiming the credit. Topic D, calculating the credit. E, receiving the credit on your 2020 tax return. Topic F, finding the first and second economic impact payments to calculate the credit. And finally, topic G, correcting issues after your 2020 return was filed. This is probably going to be updated. It's updated now for the frequently asked questions on the 2020 return. We still aren't certain what's going to happen with the 2021 return. We do know that the Build Back Better Act and all of its tax provisions is not going to pass in 2021, and you can't make retroactive changes in tax rates passing into something in 2022, so we wait and see on that one. The IRS says no to tax-exempt status. Why? I thought it was interesting. 14 organizations lost their tax-exempt status or did not get it to start with. What were the common faults with the application or their operation? Either they failed to show that they operated exclusively for tax-exempt purposes, or they failed to show that no part of their net earnings would benefit its shareholders or individuals not part of the charitable class for which they were granted exempt status. The organizations included amateur field hockey, social activities for a work group, a business promotion group, a historic preservation foundation, funding small businesses, a hospital, free medical care for underprivileged, and finally, a church. So The fact that you're a hospital or a church is no guarantee of either getting or retaining tax-exempt status. You must operate in accordance with the rules. Filing a Form 1023 is no guarantee of success. Next, a special charitable deduction is available for 2021. Want to make sure in your planning for in late December that you pick that up. It's $300 on an individual return, $600 on a joint return, in addition to any standard deduction. And that deduction is claimed on line 12B, the face of your 2021 Form 1040. When are you actively engaged in a trade or business? Good question. Varden Antonien found out the hard way that he wasn't. He wasn't entitled to vehicle and travel expenses in 2015 because he wasn't actively engaged in a trade or business. A lot of costs were incurred in earlier years. He started the Paradise Venture back in 2012, but at best it was in development during those 2012, 13, 14. The only use was personal. Model rocket launches, other things, other activities out there on this 10 acres in the middle of the desert. His testimony, by the way, was incredible. Now, that's not the traditional definition of incredible. His testimony simply was not credible. So the judge used the word incredible. He had incomplete records. The records were a little sketchy, and his testimony just didn't convince the judge that he really was engaged in a trade or business for the purpose of making a profit in 2015. Oops! The IRS changes its compensation reporting by exempt organizations for 20 years. Under announcement 2001-33, exempt organizations were deemed to have a reasonable cause supporting their compensation to highly compensated individuals if they reported the amounts paid to a management company or to whoever actually paid the individual, no more. Exempt organizations must now follow the specific instructions on the Form 990, the 990EZ, or the 990PF. That will guarantee transparency. It assures compliance by making it easier for the public and the IRS to understand the financial operations and to see how much is being paid to executives of an exempt organization. Not a bad idea. I'd like to know. Bankruptcy court separates the tax result from the tax attribute. Wow, I'd never thought about how you would do that. A post-petition tax refund was not property of the taxpayer's bankruptcy estate because the net operating loss used to generate it could not be separated from the bankruptcy estate. So the taxpayers are ordered to file an amended return giving up the NOL, which means they're going to give up the refund, right? No. The refund is still not recoverable by the trustee because the non-debtor spouse was the only one who worked during the year, and the refund is attributable to her wages and not covered by the NOL. Sometimes you read these things and you think, well, did they do it right? How would I have done it? All of these cases are learning opportunities. The Lees had no right to use the pre-petition losses to offset the non-filing spouse's tax liability. The trustee was just engaged in a useless exercise. The withholding attributable to the working spouse, they were going to get to keep. Next, these 4 practice units on relatively obscure topics, but I thought we would, because I always report the publishing of these practice units. Treaty-based exemptions for teachers, trainees, and researchers. These people come here on special visas. The question here, is there a treaty-based exemption for the income that they earn from being engaged in a trade or business, or employment outside the specific purpose of their visa. And then one of the practice units is on tax shelter promoter investigations. What documents are to be collected, how to make the case to shut down a tax shelter. The beat tax is no big deal in my practice. I doubt it is in yours either. And then the effects of flow-through entities on the foreign tax credit can arise. Does the foreign tax credit pass through tiered flow-through entities to finally get into the return of someone that can use it or an entity that can use it? For record keeping, dooms the taxpayer's return of positions. Mark Kelly and his wife owned a limited liability company, big business with the federal government, sales of $40 million, but then the bottom fell out because they lost the government contract. They claim that they were putting money into this deal. They were transferring money from other entities. And this is an LLC, so the losses would be reported in their individual returns, but they couldn't document the claim transfer of the funds. Outside the reorganization, they failed to prove personal insolvency. So they had two problems. They failed to establish their basis in the reorganization, and then they failed to prove personal insolvency. So the bankruptcy judge, with that combination, allowed the IRS to claim over $4 million in income tax liability against the Kellys, partly from the reorganization, but primarily because they could not establish insolvency. If they were in fact insolvent, then there would be no income from forgiveness of indebtedness, never mind the Chapter 11 action. It was interesting for me because of the interplay between the Chapter 11 rule on debt forgiveness and the insolvency rule. But both of those are articulated in Section 108 on income from forgiveness of indebtedness. We've talked about that in this program once or twice. Remote work may be the new norm. State tax problems loom. Sometimes I get a kick out of writing these headlines. State tax problems loom. Tax notes today, just an article by Amy Hodges. Those states over there on the right are just examples. I could list over 24 other states expecting both nexus and situs issues as a result of COVID-19. Through December 31st, important for us, South Carolina employers will not use a temporary change of an employee's work location due to COVID-19 to impose a South Carolina withholding requirement. Accordingly, the wages of non-resident employees temporarily working remotely in another state instead of their regular South Carolina business location will still be subject to South Carolina withholding. So if you're temporarily working in another state, you're still going to be subject to South Carolina withholding, but employers will not use a temporary change of your work location to impose South Carolina withholding if you were not subject to South Carolina withholding before. Just as a note, employees are free from state taxes in Alaska, Florida, Nevada, New Hampshire, South Dakota, Tennessee, Texas, Washington, and Wyoming. And income earned by someone who was in Vermont for more than 2 weeks is still subject to that state's income tax without regard for legal residency, so you could be subject to the Vermont income tax and the New Hampshire income tax or the New York income tax. So you want to be really careful up there in the Northeast. Here, South Carolina law is a little easier to understand and to apply. IRS updates guidance on changes in accounting method, updating Revenue Procedure 2021-52 and issuing RevProc 2022-9. When and how is disclosure on a taxpayer's income tax return adequate to avoid a penalty, and procedures under Section 446 to obtain automatic consent to change methods of accounting to comply with the final small business regulations issued after the Tax Cuts and Jobs Act. These changes in accounting methods would be necessary when you revoke an election and to remove a netting option which was available. We'll take a look at the regulations. Treasury Decision 99-42. Wait a minute. What? Proper disclosure avoids penalty? Yes. Revenue Procedure 2001-52, just as a reminder, this is an annual RevProc. The penalty rate is generally 20%, although it could be more. The amounts that you're claiming must be verifiable. The item to which the amounts relate must have a reasonable basis. If a pre-printed description on the form is not adequate, then additional information must be attached to clearly describe the item. For example, taxes is not adequate. Each type of tax and the amount must be listed. That's going to be in a attachment to the return. There's just a line item on Schedule C, for example, that says taxes. Well, what kind of taxes? How much and to whom? So you have to attach a statement giving the IRS the detail if you're claiming a deduction for taxes. The bottom line, I think, is there should simply be no unanswered questions about the item in the return. Wow, that went fast. Until next time, please stay safe. See you next week.